Welcome back to Beta Accounting Tutor. Today we'll be discussing the balance sheet. The purpose of the balance sheet is to provide a snapshot of a company's assets, liabilities, and stockholders' equity at a specific moment in time. Typically, the left side of the balance sheet lists all the assets, while the right side lists the liabilities, followed by stockholders' equity. Look familiar? It matches the accounting equation. The balance sheet is useful when estimating a company's liquidity and solvency, but it has its limitations. One big downside is that the balance sheet is a snapshot. It does not explain much in terms of context. In order to get this context, we have to use other financial statements, such as the income statement and cash flow statement, which we will discuss in future videos. Now let's take a closer look at the balance sheet. Assets are typically recorded at their book value, which usually corresponds to the original cost paid by the company, and listed from the most liquid to the least liquid. Liquidity is a measure of ability to turn the asset into cash as quickly as possible without losing value. And assets are usually categorized into current assets, which can be reasonably expected to be liquidated within a year, and long-term assets, which have a longer life. The most common forms of current assets are cash, accounts receivable, and inventory, and long-term assets include property, plant, and equipment, commonly referred to as PP&E. Liabilities are also recorded at their book value and listed from the most liquid to the least liquid. Most common forms of current liabilities are accounts payable, which represents informal short-term debt owed to a company's creditors, typically in exchange for purchase of an asset, and other accrued liabilities, which are generally bills that you've gotten but haven't paid, such as an electric bill. Long-term liabilities generally include notes payable, which is a formal debt with defined terms laid out in a contract, and bonds payable, which is another form of debt with a different format contract. Stockholders' equity lists the book value of all shares outstanding, which represent ownership in the company and a claim to the company's assets and earnings. It also includes a special account called retained earnings, which is an account used to track every bit of income that has not been paid out in the form of dividends since the beginning of the company. We hope this introduction helped you gain a better understanding of balance sheets. We understand you probably have more questions at this point, but don't worry, we'll be back to take a deeper look at each section of the balance sheet in a later video. That's all for today. Don't forget to like and subscribe, and we'll see you next time.
Kind of like that.